Something important is happening right now in global markets, and most investors aren't paying close enough attention. China has been steadily reducing its holdings of United States Treasuries, and while this hasn't caused panic or headlines on the scale of other financial stories, it's one of the clearest signals that the world is shifting in ways many people don't yet understand. I've been investing for more than 7 decades, and if there's one thing that has served me well, it's paying attention to quiet moves that reveal big intentions. When a major country changes how it manages its reserves, that's not noise. That's strategy. And right now, China's strategy is telling us something every investor should consider. Before I go further, let me be clear about something. I'm not predicting the end of the United States dollar. I'm not predicting a crisis tomorrow morning. That's not how long-term investing works. But I am saying that when a nation as large and influential as China shifts away from United States Treasuries, that move sends ripples through the global financial system, ripples that can eventually become waves. The world today is more interconnected than it has ever been. Every decision from major economic powers influences currencies, interest rates, global demand, and investor confidence. Ignoring a change of this magnitude would be unwise. Let's start with the basic question. Why does China hold United States Treasuries in the first place? For decades, China has accumulated dollars through its role as a manufacturing powerhouse. When you sell goods to the world, you receive dollars. When you receive dollars, you need to hold them somewhere safe. For China, the safest and most liquid place to store trillions of dollars has always been United States Treasuries. They provide stability, reliability, and a predictable return. And for the United States, having China buy treasuries has helped keep borrowing costs low. It has been a mutually beneficial relationship shaped by global trade and by trust in America's financial system. But relationships change, and recently China has been reducing its exposure, not abruptly, not with dramatic announcements, but gradually, month after month, year after year. The numbers show a clear pattern. China is not holding as many treasuries as it once did. And anytime a major buyer slows down, the rest of the market eventually feels the shift. When a player that large steps back, even gradually, someone else must step forward to fill that space, and the terms of that new participation won't always be as comfortable as the old ones. Now let me explain something important. China reducing its treasury holdings is not the same as China abandoning them. They're not selling everything, they're not exiting the system, but they are diversifying. They're reducing concentration risk. They're spreading their exposure into other assets, other currencies, other regions. And when a country begins to diversify its reserves, that's rarely a short-term decision. It's usually the start of a long structural shift. I've seen this type of move before. In the 1970s, the global system went through major adjustments as countries rethought their reserve strategies. In the late 1990s and the early 2000s, emerging markets began diversifying more aggressively. Whenever global powers adjust how they hold reserves, it signals a change in how they see the future. And China's reduction in United States Treasuries is part of a broader view that the world is entering a different era, one where economic power is more spread out, where supply chains are shifting, and where nations want more control over their financial destiny. But here's what concerns me more than the simple fact of selling: why China is doing it. When a country reduces its treasury holdings, it can be for a few reasons. Maybe they need liquidity domestically. Maybe they want to defend their currency. Maybe they want to reduce vulnerability to sanctions or geopolitical pressure. Or maybe, and this is key, they see long-term risks in holding too much United States debt relative to other assets. When you hold a large amount of another country's debt, you hold exposure to their policies, their inflation, their interest rates, and their political decisions. That exposure can be uncomfortable if you believe the future will be more volatile. China, reducing its holdings, should also remind investors that United States Treasuries, while safe, are not immune to shifts in demand. The United States issues large amounts of debt every year. For decades, global buyers, including China, absorbed that supply without hesitation. But if major buyers reduce their participation, the natural consequence is upward pressure on yields. And when yields rise, borrowing costs rise for everything, from mortgages to corporate loans to government spending. That impacts markets far beyond Treasury auctions. Another point worth noting, China's reduction in treasuries doesn't just affect the United States, it affects China itself. Selling treasuries doesn't make them more money in the short term. Often it's a trade-off, a way to free up capital or reduce long-term dependence on a single asset class. And that move, done consistently over time, reshapes currency relationships. As China sells treasuries, it sometimes uses the proceeds to support its own currency, the yuan. Other times, it reallocates into commodities, gold, or strategic foreign assets. Each of these decisions reflects a view of the future that investors should pay attention to. Something else I've learned over many decades is this: when a large economic power changes its behavior quietly, the reasoning is almost always long-term. China isn't thinking about next month. They're thinking about the next decade. And when you look at their trend over the past several years, it's clear that reducing Treasury exposure is part of a deliberate path, not an impulsive one. But let me emphasize again, this isn't a crisis, it's a signal. Signals matter. I built my career by paying attention to what others ignore. When a quiet shift continues long enough, it becomes a major event in hindsight, and China's ongoing reduction of United States Treasury holdings is exactly that kind of quiet shift. Now let's talk about how this affects individual investors. You don't need to be a bond trader or currency expert to understand the impact. When a major buyer reduces participation, yields tend to rise. When yields rise, the cost of capital across the entire economy increases. Higher borrowing costs, slow expansion, impact stock valuations, and change how investors calculate risk. And when borrowing becomes more expensive for corporations, they become more cautious. Markets become more selective, and investors need to be more discerning than ever. The world is entering an era where capital will no longer be as cheap as it once was, and China stepping back from treasuries is one part of that broader shift. When global conditions change, investors who fail to adjust often get caught off guard, but those who understand the signals early, the ones who recognize how the puzzle pieces fit, position themselves to avoid unnecessary risk and take advantage of emerging opportunities. This is why I'm discussing this today. Not because I believe a crisis is imminent, but because I believe thoughtful investors should recognize what China's reduction in United States Treasuries really means. It means the world is evolving. It means financial relationships are shifting. It means reliance on old assumptions could be costly. And it means the global market is preparing for a different balance of power. The smartest investors aren't the ones who predict the future perfectly. They're the ones who notice structural changes early and adjust before the majority sees what's coming. This move by China is exactly that kind of structural change. China's steady reduction of Treasury holdings reflects a deeper shift in how major economies are preparing for the future. When a country that once relied heavily on United States debt begins to scale back, it signals a broader adjustment in global strategy. This isn't a sudden reaction. It's a long-term rebalancing driven by caution, ambition, and an awareness that the world is entering a more uncertain financial era. China understands that depending too heavily on one asset, even one as trusted as United States Treasuries, creates vulnerability. And reducing that vulnerability has become part of their long-game approach. A move like this also changes the financial landscape for the United States. When a major buyer becomes a smaller participant, the market naturally adjusts. Higher Treasury yields can emerge, not because of crisis, but because supply must be absorbed differently. And higher yields have a way of influencing every corner of the economy. Borrowing becomes more expensive. Corporations feel the difference. Governments feel the difference. Home buyers feel the difference. Investors who once relied on predictable conditions suddenly face a new environment, shaped by decisions made thousands of miles away. China's shift also reflects domestic priorities. They may need flexibility to manage their currency. They may want reserves positioned in areas tied to long-term resource security. They may prefer assets that support their geopolitical goals. None of this happens by accident. Major economies do not adjust their reserves without a strategy, and every piece of that strategy speaks to how they view the next decade. For investors, the lesson is simple. When the world changes quietly, those who pay attention gain an advantage. For years, markets were built on the assumption that global buyers, especially China, would always support United States debt at predictable levels. But assumptions are not guarantees. Conditions change, motivations shift, and investors who fail to adapt risk being caught in the middle of a transition they didn't see coming. China reducing its Treasury holdings isn't about fear, it's about recognizing the direction of global movement. As capital flows evolve, so does the environment in which every investor operates. Understanding that shift is not optional. It's essential for anyone who wants to navigate the years ahead with insight rather than reaction. The most meaningful question for investors now is not why China has been reducing its Treasury holdings, but what this shift means for the future. When a major player changes its approach to reserve management, the ripple effects reach far beyond the bond market. It shapes how nations interact, how currencies move, and how capital flows across borders. And because the United States relies on the Treasury market as the foundation of its financial system, any change in long-term demand has real consequences. It influences interest rates, government financing, and investor expectations for years to come. I've always believed that markets adapt, but they don't adapt instantly. When global conditions shift, people adjust slowly at first, then all at once when they realize the old assumptions no longer hold. Investors spent decades assuming that demand for United States Treasuries would always be steady, always be deep, and always be supported by major buyers like China. But when one of those buyers decides to step back, even gradually, the structure begins to change. Not overnight, but inevitably. And investors who understand this early prepare themselves long before the crowd wakes up to the reality. China's choice to reduce its exposure also reflects how nations are thinking about risk in a new era. The world is not as predictable as it once seemed. Supply chains are shifting. Geopolitical tensions rise and fall. Economies are competing more directly. In this kind of environment, countries want greater flexibility. They want more control. They want options. And diversifying away from a single large holding, especially one tied to another nation's policy decisions, is a natural step in that direction. For individual investors, the most important thing to understand is that higher Treasury yields are not a small detail. They affect the valuation of every asset class. They influence the price investors are willing to pay for stocks. They affect how companies plan expansion, how governments fund programs, and how households manage debt. Rising yields tighten the system. They reward patience, punish speculation, and expose any part of the market that relied on easy money. And the gradual shift in global demand for treasuries is one factor contributing to that tightening. This is why I've always emphasized quality. In periods where borrowing costs rise and capital becomes more selective, the strongest companies stand out. They don't depend on debt to survive. They don't rely on perfect conditions to grow. They can stand on their own even when the financial environment becomes challenging. Those are the businesses worth holding when the world is rearranging itself. China reducing its treasury holdings is not a crisis in itself. It's a signal, a reminder that the financial landscape is changing, that old assumptions need to be re-examined, and that global power balances are shifting in real time. No investor needs to be fearful of this, but every investor should be aware of it. Awareness turns uncertainty into opportunity. Preparation turns complexity into clarity. The world is moving toward a new equilibrium, and understanding these shifts early allows you to navigate that change with confidence rather than confusion. I've lived long enough to know that the smartest investors aren't the ones who predict every turn. They're the ones who adjust before the turn becomes obvious. China's long-term strategy is evolving, and in times like this, staying disciplined, thoughtful, and patient becomes more important than ever.